Welcome to ESGX Live, the community for information and education to inspire collaboration and action to help build a more resilient and more inclusive economy and indeed societies around the world. With me, Nigel Lake in New York, and my co-host Paul Herman in San Francisco. A very good morning to everyone who's joined us in the Asia Pacific region. Thank you for getting up early. Good afternoon to those of you with us in the Americas, and thanks for staying up late in Europe and Africa. Just as a very brief introduction to what we're going to talk about today, and to give a little bit of a sense as to why I think this is important to me and why it's so interesting to me, to talk a little bit about the world we live in. Of course, many people around the world live in cities. In fact, if you look at the statistics, and we showed some of these if you caught it in the preview, the population now in the urban environment has passed that in the rural environment and is continuing to grow, whereas an urban population is relatively stable. If you look globally, then in most countries, most of the population lives in an urban environment. So what we do in cities matters very much. One of the countries hiding behind me there is Australia. And one of the facts which very few Americans would be aware of, and almost no one in Australia is aware of, is that it is one of the most urban countries in the world, despite the fact that Australia has a population of only about 25 million people, so it's slightly bigger than Florida or New York State. Almost everyone lives in a handful of cities, and if those cities were in the US, Sydney or Melbourne would be the second biggest city, which is a somewhat crazy statistic. So all of this matters. What we do and how we live and how sustainably we live in the urban environment is incredibly important in lots of different ways. So with that as introduction, I will hand over in a second to Paul Herman. Please do say hello to each other in the chat function down the bottom of your screen. If you've got ideas and thoughts and suggestions, add them there and we will see those and respond to them. Particularly if you have questions, if you put them in the Q&A function, it's easier for us to manage and spot where they are, but we will seek to answer them wherever they turn up. And of course, please do share this with your friends. If you're watching on YouTube, hit the like button and about 15 more people will hear our guests' messages. So with that, Paul, over to you.
Thank you, Nigel, and welcome everybody to ESGX. I'm Paul Herman in San Francisco and really excited about building greener communities today. Nick Gower, our producer, is going to run a few slides for me, and then I'll turn it over to Bruce Kahn and our panel covering leaders in real estate. So what we're going to talk about today is building greener communities, and this is one of my favorite images. Is on the left is sort of a scorched earth that we're seeking to avoid. And on the right is the utopian green sustainability we're all trying to achieve. And so the closer we can get to the right is where sustainability can take us. And the closer to the left is will be an environment that we probably don't want to live in. So just, I'm going to give a couple of financials. So on this next slide, here's the disclosures and disclaimers. Remember that past performance is not indicative of future results. So on the next slide, what we're excited about are investing in sustainable real estate. One of the 6 equity strategies that we run at HIP Investor is sustainable real estate. Now has an 8.5-year track record. So on the next slide, a company that has been part of that portfolio and part of the top 10 for almost the whole existence over 8.5 years is Prologis. Prologis has even acquired some of the other companies in the portfolio along the way. One of the important metrics, future-based metrics, is committing to a reduction in Scope 1 and Scope 2 greenhouse gas emissions. And so for Prologis, by 2025, they're looking to cut that by 21%. And by 2040, just 20 years away, more than half. And this is in buildings, primarily buildings, that usually accounts for 40% of greenhouse gas emissions, at least in a city. So on the next slide, this is the glide path of Prologis towards 2025. They're ahead of schedule, they're ahead of plan in putting in renewable energy, in green, efficient buildings that are more pleasant to be in. Those can actually generate higher rents and have lower turnover, as well as lower empty time when clients, when renters do change, leaseholders do change. And so their efficiency is going up. And so Prologis is one of the leaders in this science-based target. There's a handful of science-based real estate companies using science-based targets for greenhouse gas reductions or renewable energy, including on some of our former ESGX episodes when during Earth Week based on science-based targets. So check that out. So on the next slide, these are examples of names that you might see if you invest in a real estate portfolio. American Tower is building 5G towers as well as operating 4 and 3G towers. Equinix operates data centers. And you see a mix of other types of REITs, including Hannon Armstrong, which is putting in place renewable energy on buildings, especially government buildings. And they generally have a high yield. So we talk about this as like generating impact, but also income. On the next slide, the impact metrics, and Stok may talk about this on the panel as they've created a white paper of building healthier buildings. These are not only environmental metrics like renewable power and water efficiency, but higher employee retention and satisfaction in the REIT companies who operate these, as well as in the renters, and that they serve more diverse populations. So on the next slide, as you'll see, the fundamentals of REITs are similar to the fundamentals of most companies on return on assets. So something called FFO, or funds from operations, is like a cash flow number. And then REITs are generally leveraged up. They use debt for this physical investment. So one of the topics is we're going to talk about commercial pace. And that's essentially using debt to help finance the energy and sustainability improvements. One other factor over the next year or two, and a panel I'm sure will cover this, is on the next slide, is what's the impact of COVID-19? As obviously we have this Zoom webinar, since many of us are working from home, and companies are cutting either being required to show up to work. So Google is saying don't come to work if you're a Googler employee until next July at least. And certainly larger, denser office space is going to be impacted. So one of the ways you can do this as an investor is to tilt towards things like infrastructure REITs, we talked about Hannon Armstrong, or data center REITs like Equinix, and tilt away from even real estate services, which are the companies that run the efficiencies inside buildings. So Jones Lang LaSalle, another highly sustainability focused company, they're the ones who revitalized the Empire State Building, replacing the thousands of windows and thousands of radiators. As there's less building capacity, some of those financials will be affected, like CBRE was in its earnings call this week. So on the next slide, I think this is where we're going to end. Yeah, so it's possible to beat the regular benchmark by investing sustainably. And in up markets, REITs typically have a higher beta, so that's on the upside. And in market crises, like the end of 2018 and the first quarter of this year, they can be tense. We had a pretty great July, which we're excited about, more than 400 basis points of outperformance. So that's the end of the slides here. We'll post these on the ESGX webpage in case you want to cover them. Now I want to review them. Now I want to turn it over to Bruce Kahn. Bruce is a longtime leader in sustainability, including in sustainable real estate. And he's teaching those skills at Columbia University to the current and next generation leaders in finance. And Bruce has always been on the forefront of pushing sustainability metrics and how they integrate on a fundamental way with business and profit. So Bruce Kahn, welcome, and delighted you can lead today's discussion and panel on building greener communities.
Great, thank you very much, Paul. Thank you for that, those kind words and the introductory summary of what's happening in the REIT sector. And thanks to Nigel, also from ESGX, for hosting our panel on green buildings and green communities. And what we wanted to start to do, we're going to hear from a variety of experts. First, we're going to hear from Roxana Isaiu, who is from GRESB, one of the leading framework assessors of green real estate. We'll hear from Jason Breede from Lauren Zullo from Jonathan Rose Companies, and Michael Billingsley from Greenworks Lending. But but first, what I wanted to do is kind of set the stage from an economics perspective to think about where we are in the economic cycle. And if we look at some of the major economic corrections that we've seen in the past, Nick, if you could throw up the first slide here. We at first we saw we had the major oil embargo, recession and crisis in 1974, which then led to some inflation, and people were paying very high interest rates. One of the next major economic corrections was the S&L bank crisis in the 90s. Many of you may remember that, where we got out of it through federal intervention. Then another item that comes to mind in terms of economics is the long-term capital management decline and the Russian debt crisis. Didn't really lead to a recession necessarily, but it was it got people very scared about global contagion and financial connectedness. The tech wreck and 9.
Hi, Bruce, your audio is going in and out. So just in case, I'll jump in to moderate the panel, but.
Yeah, I apologize. I am in the middle of a hurricane, which is also another challenge that we're all facing. So we had the tech wreck and 9/11, which caused great economic uncertainty. And then today, we're still feeling the ramifications of the great financial recession caused by underwriting standards that went awry. And so where we see ourselves today is really an unprecedented recessionary type strategy. So if we go to the next slide, Nick, we find that right now, back in 2008, where we saw spreads of the commercial mortgage-backed security, CMBS, really falling out dramatically. Line is the triple credit spread from Treasury, where the blue and the green lines is the blue line is the index and the green line is the index.
All right, we're in the middle of climate change, literally, with the hurricane coming up the coast in New York. So I think one of the messages that Bruce wants to hit is the difference in risk over time and during crises.
Yeah, sorry, that's twice. Okay, so then if we go, but what happened is the federal government intervened and kept spreads from widening out too tremendously here back in 2020. But what I really want to emphasize is the next slide is if you see the rate of delinquencies across various property types, you see that the green bar is a 30-day, the blue bar is a 60-day, the 90-day is yellow, and then the foreclosure rate. You see the run-up in 2008, 2009 of delinquencies of all types of property led to foreclosures. It took about 5 years until 2014, 2015 for the real estate sector to really kind of come back to normal. And so we think that this economic situation is going to repeat itself in commercial real estate. And what I'd like to point out is we're looking now at the flow of funds. There's something like $100 billion of fresh powder out there in commercial real estate investments that are where to go. And so it struck me that, well, if we could commandeer that capital and direct it towards better higher performing buildings, better community development activities, more energy efficiency in our built environment, that would lead us a long way to not only solving the economic crisis that is here, because these are real this is real economy dollars going out into the market, but also we would solve some of the community problems we're facing, not just in the US, globally, but definitely in the US, as well as reducing the energy consumption by the built environment. So that's what kind of prompted me to pull together these experts on well, okay, we've got this $100 billion of capital just waiting to pounce into the commercial real estate area. How do we direct it? How do we think about it in terms of framework, opportunities? Where are there activities going on that we can double down in? And so first we're going to hear from Roxana about the framework and how we should think about that through the GRESB framework. I apologize, I call it GRESB. And then we'll hear from Stok on high performance buildings. What does that mean? And then our two examples of the Jonathan Rose companies, their efforts in community development and sustainability investing, as well as from Michael Billingsley and what they're doing at Greenworks Lending in terms of deploying capital for energy efficiency. So that's kind of the idea of this seminar. And we entertain any questions, any comments that you have both on high performance buildings, communities, or the general economics. You know, economics is the dismal science of prognostication with as best data you have. And that's where we are today, kind of muddling through, as they say in economics. So with that, I'm going to ask Roxana to take us through what does GRESB do and how can we best use this framework to channel all that capital into a more sustainable built environment.
All right, thank you, Bruce, for the introduction. I hope you can all see and hear me properly. And that was a great intro. What I mostly get out of it is, you know, crises lead to innovation. And on the principle, never let a good crisis go to waste, GRESB was created in 2009, right at the heels of the crisis, the Great Recession, as you put it on your slide, of 2008. Out of a need of institutional investors to sort of think of their capital allocation processes slightly different and take a more long-term approach when it comes to allocating their capital, particularly in the real asset sector, which is more tangible, more long-term, and an area where they could, where they thought they could focus their ESG efforts best as a starting point. So GRESB is used to stand for Global Real Estate Sustainability Benchmark, and is the global ESG benchmark for real assets. Basically, we evaluate the performance of real estate portfolios as well as infrastructure funds and assets based on their ESG performance at the fund level as organizations, so as fund managers, as listed companies. And I was glad to see the example of Prologis, which is one of the long-term participants and members of GRESB with excellent results. But also on the back of, so also looking at the performance of the underlying assets within the real estate portfolios. Those assets can either be under development or they can be operational. And obviously, when you think of what constitutes ESG performance for an asset that is under development or an asset that is fully operational, has tenants, collects rents, and contributes to its community, those metrics that you need to look at are slightly different. And so what you see on this slide are basically those aspects that institutional investors generally think are the most relevant ones they need to be looking at when evaluating the funds and the companies they invest in. And my panel colleagues will speak more to the specifics of how to improve individual assets, and they're better positioned to talk to the technical improvements of assets that lead to reductions in carbon emissions and more comfort and indoor air quality and things like that. What I've been observing over the past 10 years with GRESB, and more looking at the signals from the regulators, as well as from banks, lenders, and equity providers, so also investors, is that yes, the underlying assets are ultimately what they're really interested in, because they want to allocate capital to assets that are able to withstand long-term physical, transition, and social risks. They're also very interested to know in evaluating the companies, the managers that they work with. And that's why it's important to look at the combination of factors that don't only portray or depict the individual assets, but also the company that's managing it. And if you look at the next slide, you can see there's an array of issues that we look at when evaluating each portfolio. And each fund or each company that uses our framework basically needs to report on a set of indicators that come from all of these aspects, all of these themes. And based on the information they provide, following a scoring and validation exercise performed by GRESB, we assign a score, an overall fund score that is then used by investors in their individual engagement with managers and in setting new targets and new improvement targets and new improvement pathways. So far, I have to say I am not aware of any institutional investors that said, I'm going to divest from this fund simply because they got a GRESB score of 20 out of 100, which is the maximum number of points. So, and I see that that's sometimes a reason for concern for companies to, when asked to disclose information on ESG, they're not really sure what it is. They don't have a lot of processes within their organizations. They don't really know if they're going to do well. So they're skeptical to start disclosing because they don't really know how they're going to fare against other companies. I haven't heard of any institutional investor that said, we'll divest the next day because you have a low GRESB score. But what I have heard of are cases where institutional investors give ultimatums and really insist on companies to start disclosing as little as they can, but as fast as they can, because disclosure is the first step to everything. And if we go on the next slide, I also wanted to show just a little snippet, just some insights from the data we collected last year in 2019. These are some of the results that come from asset level analytics. So from the data on, from the energy consumption data reported by the portfolios that reported to GRESB last year, there's a number of metrics that for which we collect the data and for which we analyze the data at the asset level, particularly on energy, carbon, water, waste, building certifications, and now also efficiency measures. And so we are able to produce insights like this for you to, well, first of all, for the companies that report and for investors that use this data to evaluate and to use in their engagement exercises with the fund managers. I would be curious to hear your thoughts around these numbers. So if we just evaluate the average energy use intensities from the 2019 data set in the US, we can see that the average office intensity based on 3,280 assets was something around 220 kilowatt hour per square meter. Does that sound low? Does that sound high? Is that in line with your own calculations? Well, what do you think? What do you think these numbers tell you? And if you're not really sure how your assets do operate, well, then it means you need to start tracking the data. And effectively, that's what we've been pushing for. That's the market behavior we've been encouraging, and that's the kind of dialogue we've been facilitating between managers and investors over the last 10 years. And we feel like a lot of work has been done and is underway in the sector, but there's a whole lot more to be done. And so there's a lot to do. I'll stop here because I want to keep a bit for the Q&A. And with that, I'll hand over to Bruce.
Yeah, Roxana, there a question came in of how will we manage the data collection given there's going to be a serious
sorry, Bruce, lost you there a bit, but I think the question is, how are we going to manage the data collection given the fact that a lot of assets have been under lockdown, impacted by the lockdown in 2020? Don't see the question right now. Well, there's obviously 2020 is not a typical year, and no matter what we do with normalizing the values and normalizing the data, we're always going to have this asterisk next to the data point saying values have been normalized, or assumptions have been made to account for the fact that there were periods of time where the assets were not used. But I think this is also a very interesting forced exercise that property managers are already doing at the moment to really test the impact of occupancy rates and the assets actually being used. Are the consumption values actually dropping by a whole lot, or is the impact not that significant? And I think the answer really depends on the sector. I think it really depends by the country as well. But I've had some interesting conversations with participants over the last month saying, yeah, we had our assets or retail or offices closed for a couple of months, and we were expecting the values to go down, well, close to negligible values, but somehow they dropped by 20%, by 30%, and we're not really sure why that is. And I think this crisis that we're currently in, because this is also a crisis, will force us to think of new ways to innovate and, well, really to optimize and to do better in terms of data management, asset monitoring, and automated systems. Bruce, can you still hear us?
This is Paul. So thanks, Roxana, for that overview. And I think up next is Stok. Is that right?
I think that's correct.
All right. So Stok is an amazing company that helps other companies improve the sustainability and really the health profile, not only the environmental profile and the health profile. And you guys have written this white paper on the financial case for high performance buildings to show the ROI. So can you dig deeper into that?
Yeah, thanks for having me on here. I really want to sort of broadly talk about, obviously the financial case for high performance buildings. The one word that comes to mind, and I think we're all feeling it now, is we're really talking about the resilience of our built environment and how we all interact with it. And at Stok, you can say that we're in a lot of ways your general practitioner for your building. Like we are very agnostic to the tools you use, to the systems you use. We like to be that reference that you have, that partner in understanding your building, and especially, in my case, I have a master's degree in mechanical engineering. Really dig into those systems that are behind the scenes and how those play into the productivity, the retention, the wellness, your energy usage, because those are all vital to your assets' resilience when things come up, especially with climate change, especially with global pandemics. So we've really noticed, we've worked with a lot of tech clients here in the Bay Area. That we've been advising clients and working with clients to understand that if you go beyond code, if you have better indoor air quality than is required, your assets there, they have a improved wellness, which actually results in higher productivity. But that also means that if you have a crazy wildfire like we did last year and the year before that, you can improve the air quality inside the building to better than outside. Which again provides a place for your employees to go for a little bit of respite and continue their productivity. And so when we're talking about sustainability of buildings and the ROI, I really like to think about Ray Anderson and Interface, who, back in the mid 90s, he was one of the first people to really, as an industrialist, take on sustainability. And he credits that work with being able to get through the economic crisis of the early 2000s and then again in 2008. So when we're working on sustainability, there are lots of ways that we can think about it. But what we're talking about is understanding that this work we're doing up front will provide asset resilience for whatever's coming down the line, because we don't know. And doing that work up front, understanding your buildings, understanding the improved productivity, retention, wellness, will provide an ROI benefit that sometimes you can't predict. But just like the assets that we're talking about at the top of this, we understand that by doing that work, you're going to get a better ROI. Sometimes it's significant. Sometimes it takes a little bit until we hit that next crisis for that to pay back. But having that general practitioner,
So you, Stok, and your team, like you work on buildings in California and Colorado and the like, what would be some of the characteristics? Because isn't it the case like cleaner air helps productivity inside a building, as well as schools, of students getting higher GPAs? What are some of those tangible things that go into a high performance building?
So for example, at Google, they mandate that their air is double. They have double the airflow per each person than is code required, while still also having double the filtration and double the energy efficiency, which is challenging. But something as simple as double the airflow, outside airflow, is it. Just one metric like that can have a huge benefit.
And what does it take to do that? Is it expensive or cheap?
You need to go into your design meeting early and just tell your designers what you want. We have amazing mechanical engineers out there, and we're often driven towards the lean end, towards that first cost. And when you come in and you just say, here's what we stand for and here's what we want, and you give that challenge to an engineer, as an engineer, we're going to jump up and down and try to find a way to make it work. So it's knowing what you want early and sticking by that, and understanding that it's not just a first cost issue.
And one of the questions from the audience is, like, now in 2020, given that many offices might either be empty or partially full, what's like the future of space look like? Is a high performance building only dedicated to one purpose or multi-purpose? How are you thinking about it?
Well, that's the real benefit when I talk about resilience is, so for example, one of the big projects we just worked on, because of the metrics they were trying to hit, they sort of intentionally have oversized air handlers and cooling coils and heating coils, which means that building can easily be converted to any of a number of uses later on. So again, by having that resiliency built in, it gives you that flexibility to potentially go from an office to a residential, or from an office to lab space, things of that nature.
Yeah, well, certainly there may be lab space needed, or
Right.
hotels needing converting to hospitals. Yeah, maybe what else? Carolyn Braun had asked this question, but do you do anything with malls? Like, how should we think about malls these days since retail is down?
Yeah, we've been working with a few clients who are looking at malls to convert them to almost little eco villages, where you can have some residential built in there, you can have some smaller shops. One of the nice things about malls is you have so much space that if you can find a way to use that space for community purposes, which is in some ways what they were used for initially, there's a lot of things you can do. The biggest thing with any building and that you need to focus on is your envelope. Like, once you've designed the system boundaries and how those boundaries work, those really don't change without a total teardown. So it's one of the areas to spend a lot of time thinking about it. But there's a lot we can do with our existing building stock right now.
All right, and then one last question, and we'll move sort of to the next panelist, and then bring everybody back in a little bit. What about for existing buildings? If you can envision, if for a new building, you can change that as it goes in. But what about existing buildings? How can you double airflow or improve the health profile?
Every building's different. So you sort of start with retro commissioning, which is where I actually started my career, which is to hire professionals to come in and really tell you what you have, and then they can help you figure out what the possibilities are. Do you have enough air capacity? Would you need to install different mechanical systems? But every building is so unique that you really need to have an evaluation done. And that is most commonly referred to as retro commissioning.
Got it. I understand. Great. Well, to check out this financial case for high performance buildings on the Stok website, STOK. And I think there's also information about your fossil fuel free 401k too. So it's exciting that Stok is a leader on applying this in the sustainability retirement investing in your own 401k plan. Great. So I think, Lauren, you want to come on next and talk about similar but sort of unique case studies that you're pursuing at Jonathan Rowe?
Definitely, and thanks for having me. Great to hear Roxana speak about GRESB. I'm only here because I had my GRESB submission due last week, so I'm in the clear now. So I wanted to talk about a different asset class, affordable housing. So the affordable housing crisis in the US has been growing, and the gap between low-income renters and available housing stock has been widening dramatically for decades. This map shows the percentage of rent-burdened households in the US. Rent burden means you spend more than 30% of your household income on housing. And to be severely rent burdened means you spend more than 50% of your income on housing. Over 12 million American households fall into that severely burdened category. In addition to that, the stock of low-income housing has been shrinking. Low-cost units have shrunk from 46% of the rental stock in 1990 to just 25% as of 2017. But in addition to being scarce, traditional affordable housing can be low quality with a host of issues that can lead to poor life outcomes. Properties are commonly located in economically or socially disadvantaged communities, often without easy access to transit or green space or healthy food options or grocery stores. So at Jonathan Rose Companies, we've developed an economic model to leverage private equity, debt, and public sources to acquire properties, green them, and deliver residents safe, green, stable, affordable housing, which we call communities of opportunity. On the next slide is an image of our Sendero Verde project in East Harlem, New York City, it's a ground up development project that will bring nearly 700 affordable housing units to the city. This project is designed to passive house standards, which uses just a fraction of the energy of traditional design. And it will incorporate a school, a healthcare clinic, an art partner, and have community gardens. And the project is designed to activate the neighborhood around it. It was a once vacant lot, and we're aiming to bring people, services, healthy living in this urban connected setting. So our approach to communities of opportunity focuses on two key impact areas. On the next slide is our social impact. Social impact for us is underpinned by the fact that we preserve unit affordability, which is typically done through renewed or extended regulatory agreements. But we go beyond that to enhance the social service offerings at our properties to help bolster community engagement and strengthen resilience. We do this through an approach called asset-based community development, which looks to our residents and asks them, what are your greatest needs and how can we help you address those? So we aim to staff a dedicated resident service coordinator at each site. And that person helps us deliver this asset-based community development approach. The collaborative approach we take has led to all sorts of initiatives around social programming, including exercise and healthy eating, adult and child education, computer literacy, financial counseling, on-site health exams, voter registration, and a whole host of activities. Importantly, we found that a majority of our residents deal with some level of food insecurity, where it becomes difficult to make it to the end of the month on their available resources. So we've partnered with numerous food banks and mobile groceries to deliver thousands of tons of food and meals to our residents. And this has been especially important during times of COVID.
And Lauren, how do those get paid for? Where is that coming out of?
Yeah, so it comes a couple ways. This is mostly the way we approach it is the resident service coordinator is the key player in making the communities of opportunity approach and the social impact work happen. And so the key is employing that person. So we find the funds to employ that person typically through, we pair this, which I'll get to in a second, with our environmental impact approach, which looks to harvest cost savings from inefficient utility usage. And so we look to kind of pair social and environmental impact that way. There also are some grants available through HUD. Those have been kind of diminished. We've been keeping a good eye on the CARES Act and trying to find different ways where we can kind of harvest some additional like government or grant support for this. But really we find that it just bolsters the economic resilience of the property. The more stable our residents' lives are, the less likely we have evictions or other, or lost tenancy at the property. So that financial stability and life stability we bring to our residents brings us stability at the financial level at the property. So these are just a few images here on this slide of some of the programs in action. And then on the next slide, we'll talk a little bit about our approach to environmental impact. It will show just a few pictures of some of the cost-effective retrofits and equipment upgrades that we make. Those are our kind of core investment approaches when it comes to environmental impact. We look to implement projects that pay back through utility cost savings. We leverage.
Can you run to the next slide? Go ahead, Lauren, continue.
Yeah, sure. Thanks. We leverage utility rebates and government incentive programs to help reduce the upfront cost and boost the IRR of our green investments. Further, we design our projects to meet Enterprise Green Communities standards. Enterprise Green Communities is similar to LEED, but designed specifically for affordable housing. So our whole holistic approach to greening that we undertake in accordance with the enterprise guidelines covers everything from transit and walkability to site maintenance, landscape, healthy materials, and daily operations, things like cleaning. And those things don't necessarily require additional investment, but they do require that you operate smarter. So we're very fortunate to have an affiliated property management company that helps us execute our green vision on the ground in about 2/3 of the properties that we own. And then we partner with a great group of third-party managers and partners across the rest of our portfolio. Beyond the retrofits and operations, we're pushing the boundaries to meet our carbon reduction goals in a few other ways. One is through strategic electrification to convert existing fossil fuel systems to electric systems, which will allow us to reap the benefits of cleaner electricity grids. And we're also installing renewable energy systems and storage wherever we can. Actually, just last week, we placed into service 3 rooftop solar PV systems that we financed through a special purpose entity that allowed us to monetize the federal investment tax credit and deliver reduced cost power to the underlying properties through power purchase agreements.
And then if you can wrap up, Lauren.
Yep. So the last piece I was just going to touch on is on the final slide, a quick case study of our Shore Hill Apartments. It's a 558 unit Section 8 senior housing complex in Brooklyn. And there's an image of it on the next slide. We acquired the property in 2018 through a joint venture for a purchase price of $150 million, with about $100 million coming in debt from Freddie Mac. We utilized Freddie Mac's Green Rewards program, which allows us to get a reduced interest rate and underwrite some of the projected property utility savings. We extended the affordability contract on all 558 units for 20 years. After the closing, we were able to get into several green rewards or several green incentive programs, including weatherization assistance and NYSERDA's multifamily performance program. So we're implementing about $1.4 million worth of green work for an owner's expense of about $600,000. We're expected to reduce utility costs about $287,000. So we're looking at a 2-year payback here. And that's paired with a much broader retrofit, which is targeted at activating our community spaces and really revitalizing that community. So we're excited to share our stories and be here today.
Fantastic. Yeah, and Jonathan Rose has been leading this charge over the past decade to integrate sustainability across the whole system. So it's really wonderful to see all the results and next set of innovations. So there's a question here, and this will be a great bridge to Michael, who focuses on commercial pace. So Lauren, if you just pause and we'll bring you back for some group questions. But Michael, commercial pace is a way to sort of facilitate some of these improvements and use savings from some of these improvements to pay for it. So can you tell us more about what that is and who can use it and how we can use it?
Absolutely. And thanks, Nigel, Paul, and Bruce for inviting me to the webinar today. I'm happy to be here. So Greenworks Lending was founded back in 2015 by Jessica Bailey and Alexander Cooley as they spun out a business out of the Green Bank, very successful and one of the most successful green banks in the country. And they spun this idea of commercial property assessed clean energy, short for CPACE. Wanted to spin that and expand that basically financing tool across the country. So with PACE essentially is a public-private partnership, a financing tool that states enact and then local counties or jurisdictions opt into. And then it basically designates energy efficiency and water conservation measures to be on a commercial real estate building to be a public benefit. And through that public benefit, you're able to finance 100% financing on all of the equipment and associated costs of that improvement. And so it's been used for a variety of different project types, and we'll discuss that in further slides. But it's been a really innovative financing tool that's come on the market, and Greenworks has been a leader in that space, and we've done the most amount of projects across the country. We recently completed our first securitization back in 2017 and did another securitization of these green assets in 2018.
And so, Michael, who institutes this? Do states need to put this in place, like in Wisconsin, or do banks lead this? Like who?
Sure. So it's, again, state enabled. So each state in the country would need to pass legislation essentially enabling a CPACE program to be developed and essentially designating any energy or water conservation measure on a building as a public benefit. And once they pass that legislation, the local cities and counties can opt into that and then utilize CPACE. And
can cities do it without states?
No, the state has to do it first. The state has to do it first, and then the cities can follow. And each state runs it differently. Some have a statewide program where all the jurisdictions are opted in or can use their program. And then sometimes they have states where they pass a general legislation, and then local cities and jurisdictions kind of have their own CPACE program, and they administer and run that themselves. But they all tend to be very similar in nature in terms of what their aim is.
And since some states tilt conservative and some states tilt progressive, does it split like that, or?
No, there's certainly some red states and blue states that certainly have PACE. We're active in about 23 different states across the country. And so surprisingly, some red states have enacted PACE because they see it as being a smart financial decision for their businesses and the bottom line. So it's kind of a universal financing tool that crosses party lines.
Got it. Understand. Okay. And are there characteristics of what the leading states are doing that the next state should do or the lagging state should adopt?
I would say the best practices for states would be to have a very long loan term. It's one of the essential parts of PACE is having 20 to 30-year loan terms that are fully amortizing. Have retroactive, where you can look back at a building that's been recently completed and you can fund those energy measures that were financed before, either through equity or through a construction loan. You can provide lower cost of capital and recapitalize the structure of that financing. And then have a program that is very inclusive. So not only do you have energy and water conservation, you might have resiliency, you might have hurricane resiliency, or earthquake resiliency, say you're here in the West Coast. So lots of different things that you can include in that, that bucket for being eligible for PACE.
Got it. All right, well, tell us more about how it works.
Okay, so you can go to the next slide. So the next slide covers all the different, I would say 3 different project types that we typically finance. So the first one being energy efficient upgrades on and deferred maintenance to existing buildings. So that's replacing your HVAC system, your lighting, your windows, your roofing, things of that extent. And then what's been really popular has been new construction and gut rehab. So developers are really caught on to using CPACE to fund gaps within their capital stack. So we're usually filling gaps between the senior lender and their equity contribution, and sometimes, a lot of times, reducing the amount of equity that developers need to put in. And it's been a really popular project type and has been popular across the country. And then lastly, but not least, is solar and renewable. We love to finance solar and renewable energy projects.
Michael, what is the mix of these? Is it mostly new construction with some upgrades? Is solar gaining? Is it gaining faster?
I would say we do about, I think I have a slide on this, but it's about 38% being solar. And then solar energy efficiency is about 14. And then we do about 48% of our projects are probably energy efficiency focused.
And what types of buildings are best for this? Office buildings, schools, malls, hospitals, data centers?
Every vertical, every different asset type, property type is eligible for CPACE. So office buildings, hotels, multifamily. We can even finance houses of worship or other nonprofit buildings. So every basically food group is available for commercial PACE.
All right, and I see here on solar, it says day 1 cash flow, meaning probably a high ROI. We love to see those payback periods short. What's the range of payback periods?
Oh, with solar, we try to have it be, like you said, cash flowing positive on day 1. So if your state has or jurisdiction has solar renewable energy credits, tax credits, plus the accelerated deferred accelerated depreciation, you can really be positive day 1 going forward on the investment because of the long loan terms that we have. So yeah, solar is definitely a great asset type to finance.
Well, quick question for that. If it pays back on day 1, why would you need a state-based PACE system? Why wouldn't you just take that loan yourself from a bank or a financer?
Sure. So with most banks, you have to put at least a 20% deposit, which is unattractive versus PACE, because PACE actually finances 100% of those energy efficient measures. So with solar, it would be the entire project, including the soft and associated costs with that project. And additionally, typical banks offer loans that are 5 to 7 years, where CPACE offers anything between 20 to 30 years, depending on what the equipment is and the expected useful life, but certainly a longer loan term, which results in a lower payment.
Got it. Okay, and so like Jake Baker's in the audience, and he's like, well, how large could these be? What would be the upper limits, either that you or can happen in these 23 states with PACE?
Sure. So it really depends on the state. Some states have set, and local jurisdictions have set a maximum for what PACE, the amount that they're willing to lend to. So in certain jurisdictions, say, for instance, there's a $20 million cap. But in most jurisdictions, there's not a cap. So what we're really lending to is in most jurisdictions, is 20 to 25% of the as stabilized value. So the fully built and stabilized property value, we can lend up to about 20 to 25%. And then, of course, we have a debt service coverage ratio. And so the cash flow we need to support the debt for that type of project. But the property value is really the governor of how much of dollars we can contribute to the project.
All right, and Carolyn Braun, she should be our moderator next time for this. Very intelligent questions. Can you refinance PACE at lower rates for recent ECMs, maybe in New York City?
Well, New York City's project New York City's program is in the works. In New York State, they do have an active PACE program. You can, in certain jurisdictions, refinance, and most of the time, you're not going to need to refinance with PACE because the rates are extremely attractive right now. So anywhere between, I would say, 5 to 6.25 are the rates that we're seeing in the market. And again, that's really attractive for that long period of, and it's fixed rate throughout the 20 to 30 years. But we do allow sometimes, certainly you start a project off, you might have a project you close and then you need to go back and do other energy efficiency measures. So sometimes we do allow a one-time recapitalization of that initial loan amount.
Got it. Understand. All right. Well, let's make sure you get your 1 or 2 more important slides up, and then we'll bring everybody back. And for the audience, we'll go to about 1/4 after. So much to learn here. Keep your questions coming. Really intelligent conversation. So Michael,
So Nick, yes, if you could skip to maybe my last 4 slides, then we might be able to just walk through typical projects we've done. That's a great one to start with. Let's go back to the multifamily one. It's back 1 slide.
What's it called?
Multifamily, I think it's the title.
Okay.
It's a DC project. Just one more forward. Might be a delay there. There we go, multifamily portfolio.
Right there.
So this is an example of a project that we did in Washington, DC and the suburbs surrounding it, where we did a portfolio of 12 multifamily buildings, invested about $5 million of PACE to essentially retrofit the existing boilers in each building. So we invested about $5 million. The loan term was 20 years. And we expect over that 20 years to have about $3.7 million in savings to that property owner. And next slide. This was a great project we did in Columbus, Ohio. We invested about $4.6 million in PACE out of the total project cost of $20 million. This building had been sitting vacant actually for over 10 years, and the developer came to us, partnered with us, and we were able to revitalize this building and do a variety of energy efficient measures to bring this building back to life and make it a contributing part of the community. And next slide. And this was a really interesting hotel project we did in El Paso, Texas, where we invested $9 million of PACE out of the total project cost being $77 million. Did a historic renovation on this one where we're doing multi-measures of energy efficient work. Both the lighting, the HVAC, and elevator were upgraded. Really historic project, great boost to the economy for El Paso, and really brought back a shining symbol for the city. And on this last slide, I'll wrap up here. We keep track of all the different sustainable measures, energy savings that our dollars are going to. And the first picture here designates and shows that about 1.2 million megawatts of electricity has been saved by our financing, and that contributes to about 90 square miles over 20 years of new forest being grown. So taking the CO2 out of the air, and that's the impact of the CPACE there. As we discussed before, this is kind of a breakdown of the different project types we do, both solar energy efficiency and combination of solar and energy efficiency. And lastly, this on the slide on the right shows kind of the overall energy savings that we've been able to track since the inception of the company. And as of Q2 of 2020, we're projecting about $380 million of energy savings that our dollars have contributed to by the improvements we financed through CPACE.
All right, well, really appreciate this deep dive, Michael. And for the audience, check your local listings, see which states are offering commercial PACE, could be a good fit. And I think they help list who the potential financiers are as well through the state. So if everybody can come back, and I think Bruce is back. Bruce, have you survived the hurricane?
I think so. The tragedy narrowly averted, although it's still looking pretty tough. Great comments from everybody. You know, there's a question from Marianne Kastenbaum to Lauren, but I think it applies to everybody in the sense that the question reads as, you know, right now, city governments and affordable housing, they kind of encourage a mixed income development, and that because that seems to be more practical, at least according to influential developmental folks. But could we increase the amount of energy efficiency and other affordable housing and community development attributes that would get us more affordable housing stock? And I think the general spirit of that question goes to all of us, which is how are we faced with kind of like conventional economic decisions with the sustainability economic decisions? All the examples given forth today are demonstrably profitable and can do it, but the headwinds are, well, you know, that's not practical, or no one's really asking for that, and or we can't do it all at once. What are people's response to that? Because if the numbers are what the numbers are, why wouldn't we do them? Why wouldn't we just do this 100% of the time? What is the pushback you get, and what is your response? And I think I could start with Michael and go back to Lauren and then to Jason on that. Like, what is the pushback you get from conventional financiers around whether it be energy efficiency or sustainability or a green building project?
Sure. A lot of the pushback we get is, you know, show me the dollars, show me the value you're adding, show me the energy savings, and can we actually trust those projected energy savings? And companies like Stok, like Jason's group, have been this instrumental in projecting out those savings, taking utility bills, looking at them, looking at escalation rates, and really being able to show the immediate savings they won by putting in a new boiler or a new HVAC system, obviously a lot more efficient than what was in place, call it 20, 30 years ago, and getting them to understand that that it is a viable execution if doing those upgrades.
Lauren, how about you? What are you finding?
Yeah, I would answer it two ways, because it's a little bit different for new development versus existing buildings. And so when it comes to our new development work, obviously there's a big push, especially in cities right now, to build more affordable housing quickly. And frankly, the upfront cost of something like passive house construction can be more significant. And so there is pushback of people saying, well, why would we build? Why would we spend more if it means we're going to build fewer units? Because these are often, you know, you often have public financing bodies coming to the table on this. And so the thought there is that we just kind of need to reconsider some of our underwriting standards and how we look at those operational savings over time. In New York City, where we're building that passive house project, there's not a good way to look at how the building's going to operate and what its financials look like going forward with the passive house operational assumptions. So I'd say that's kind of where things could be improved there. And on the existing building side, at least in the affordable multifamily space, we're working mostly with FHA, Fannie money, Freddie debt. And they've come really a long way. I would say, you know, similar to what Michael was saying, there's distrust about the numbers. Am I really going to see those savings? But Fannie and Freddie have put in a lot of work with their huge data set to prove out that those savings are there. And they've both created programs to help you underwrite towards those savings, so you can upsize your loan proceeds. So I think we're getting there in terms of underwriting these savings and trusting the numbers a little bit more.
Just a follow-up question to both of you. Are there more deals for you to be done than there is capital, or is there much more capital and not enough deals?
I would say there's a lot of capital and maybe not enough deals. Certainly, as the market started to slow with multifamily, there's just not enough new construction starts happening. But on the retrofit side, there's certainly a lot of opportunity, and on the substantial rehab side, there's a lot of opportunity in secondary and tertiary markets. So certainly, there's a lot of capital chasing deals, but I still see a good amount of good quality deals out there as well.
Mm-hmm. Yeah, we invest in our existing buildings out of several private equity funds. So we have capital that we're putting to work there. And with debt being so cheap right now, you know, we're able to really get our projects done, you know, mostly to the size that we want them to be.
I have a question here from Jake. Well, Jake Baker, but before I get to that question, Jake, I wanted just to go to Jason. Jason, do you get pushback for what you're doing, or are all your clients kind of come to you because they already, you know, see the benefits of the services you're providing?
I mean, it's a mix, and I think if we talk about you know, the benefits and the finances, you know, you have issues with snake oil salesmen on either side, right? Somebody saying that we can do first cost, you'll get a huge return. And that requires sort of the optimized market situation. And then you have the opposite. I used to work as an energy efficiency engineer, and the people that come in and be like, plug this black box into your system and you'll save millions of dollars of energy. So people don't have a high trust in some of these things on either side. And so it's really just building that trust, making sure you're being as open as you can about how your models work with saving energy and all of these things, so that the market itself and the underwriting, to Lauren's point, can really start to trust what we're saying. And it's just, again, it's just building that trust. The lead has really helped us get in front of clients who maybe haven't appreciated what we do. And then as you work with them, they understand your ability to really help them in the market. Then you work with them and you give them the best advice you can. It's just being honest with what the numbers say and not overshooting on either end.
Right, thank you. Paul, there was a question from...
Yeah, let me just tee up a couple from the question box since you had to reboot. One is from Chris Gassman.
Yeah,
Curious about examples of multi-technology projects, like is the solar wrapped around the base of a wind turbine with lights below the blades? That's one type. So like, what are cool innovations in technology that have an ROI? Another one is around opportunity zones, so that they were very popular. Are those still a thing during COVID and during sort of the timeline in the law for opportunity zones, and things that have worked or haven't worked?
I'll jump in about technology pairings that we are really excited about. One is, I mentioned strategic electrification, and that's really important when you're dealing with buildings and trying to decarbonize. You're always going to hit a floor if you're burning fossil fuel on site, right? If your building uses natural gas or uses oil, you can't decarbonize that unless you get that out of the building. So we're focused right now on, in multifamily, it's really common to heat with gas and to heat your hot water with gas. So we're looking at a lot of opportunities to electrify our domestic hot water supply. And we just did a great project out in California who is doing a great job cleaning up the grid. So it will probably be one of the first, you know, zero carbon electricity grids. But if you pair that with solar PV on your roof, then you can, you know, start to power your, or start to create your hot water, which you used to be burning fossil fuel to do through totally clean energy. And that helps you reduce some of the costs. There can be a cost increase associated with switching to electricity. So if you're pairing that with PV, then you're kind of drilling through that cost potential increase.
Thanks, Lauren.
Opportunity zones. Anything on opportunity zones from any of the panelists, including you, Bruce?
Well, yeah, at Edgewood, there was a question around our platform and how we see investor interest in green buildings and sustainability. But on the opportunity zone, we see lots of people, we see both a lot of interest in opportunity zones. We see lots of prospective borrowers for opportunity zones, but we haven't really seen any successful projects that penciled out, the finance worked, and everything kind of came together. And that may just be a function of the deal flow at this time, given COVID. But we do expect more and more borrowers to sending deals our way in that, on opportunity zones. They tend not to be so oriented around green building or sustainability. It's been my experience. Maybe you guys on the panel have some other experiences with that. They think, I guess, if it's an opportunity zone, it's kind of sustainable by definition. And as we all know, intentionality begets additionality. So we do want to have, just because it's an opportunity zone doesn't mean we can, forego water and use efficiency and energy use efficiency and the like. Does anybody have any further comments on opportunity zones? No? Okay. Paul, I did lose some of the questions. Were there any further questions, or should we see if people want to make some final comments about what they're seeing, what's their outlook for the next 6 to 18 months?
Yeah, the outlook sounds good. The one other question for you, Bruce, is where do you see investor interest in green buildings and sustainability? Are they family offices or endowments or pensions?
Well, we see all across the board. Private wealth management has done a great job at educating their clients on the benefits of sustainable investing, both in terms of aligning their values, but also the economics, as you pointed out early on, Paul. Foundations and endowments and kind of larger pensions are a little bit more reluctant to dive in this area. That's largely due to the intermediary skepticism around kind of what's called ESG. And if you follow the media, every day there's a story on this, whether it's pro or against, depending on which day it is. So I think really the private wealth area is really the more willing to invest in this manner. It's been my experience so far. Some of the families, they like to do all their stuff themselves, so they kind of mine you for information and then go do it themselves. So that's what I've experienced. I don't know how, Lauren, I know you're raising a fund in Greenworks. I'm not sure you've had a fund operation, but I know you talked to a lot of families about investments. So has that been your experience as well?
We get a lot of interest from individuals and families, but I'd say we're really seeing a lot of growth in the kind of institutional side, like in endowments and pensions both. Foundations as well, who are looking to kind of align their programmatic values with their investing values. So I think we're seeing a lot of growth in foundations and endowments, especially.
Michael, do you seek out capital partners in the endowment and foundation world?
Not in the endowment foundation world, but certainly we have investors that are in the life company space, and insurance space, ING, TI Naveen, and Carval Investors, which is a hedge fund, also is a major contributor to us. So we have a kind of a wide span of different capital providers and investors with us, but certainly all institutional. And we have some even small mom and pop funds being raised by some clients. So we accept all capital that's geared toward the energy efficiency space.
Roxana, I might throw this over to you. What has been the uptake of your framework and assessments? Has that largely been on the institutional side? And how have you seen that demand either wax or wane?
Well, it's certainly increasing. The institutional investors are the ones that demand the funds and the companies that they invest in to report to GRESB, so to use the framework. And then they are the ones using the results, the reports that come out of that reporting exercise and out of the scoring and benchmarking exercise that we perform. So Lauren just shared that Jonathan Rose finalized their 2020 assessments a week ago. Last week was also the submission deadline for 2020. And so in October, Lauren will receive her reports for Jonathan Rose, and also the institutional investors that invest in the Jonathan Rose company's funds will see the reports at the same time. And so I suppose that's a discussion for another time, exactly what the engagement process looks like, and who's the first one to pick up the phone and request a conversation about the results or set up some action items with. Institutional investors are the ones that are driving this, and depending on the space or the region, funds and companies are faster or more reluctant to respond to that demand. But there's nowhere to hide, I would say, not anymore.
Thank you. Well, would anybody like to offer some final outlook comments? I kicked off this session with my outlook, which is I think it's going to be about, another 5 years of recovery in the real estate sector before we get back to what's normal. So I think if this federal government, if governments around the world, keep interest rates low and spreads contained and inflation contained, that will be helpful. But we will see greater distress out in the commercial real estate space, and we think that those are opportunities for us, the kind of sustainable investment community, to put the money to work in a sustainable manner, and by demonstrating the positive economics that you've all discussed here today. Any further comments on Outlook, or we can wrap up with there? I think, Paul, I don't see any further questions.
Yep, I think we're good to go. So glad we could be agile and resilient on this Zoom call glad you've survived the hurricane. And I always think about in resilience during one of the earlier hurricanes in New York City, the only building with that had sort of prepped before it was the Goldman Sachs headquarters. Today, more headquarters are more prepared and resilient, but thinking ahead about risk as well as impact and sustainability is essential for our times under COVID, climate, and building a better world. So, so I want to thank everybody. Bruce, thanks for bringing us all together and all your leadership in sustainability and in real estate. Thank you, Roxana, for joining and staying up late from Europe. Really appreciate it. Thank you, Lauren, for illuminating us about all the different implementations. Michael, for how states actually can lead, at least 23 of them, and how you can help scale up available capital for income and impact. And thank you, Jason, and the team at Stok for the white paper on high performance buildings. Thanks everybody for joining on ESGX. I'm gonna turn it over to Nigel for a wrap up of good news and a preview of next week.
Fantastic. Thanks very much, Paul. And that's been a really fascinating discussion. I've certainly taken away a whole bunch of notes myself for things that I'm going to go and act on. So thank you sincerely to the panel for all that they've shared today. I was struck by one comment right at the beginning: crisis leads to innovation. Clearly, there is an opportunity to seize this. There is lots of capital ready to flow, perhaps more focused right now on some of the risks than there might have been a year ago, and we can clearly make something of that. A few things that I picked out along the way to make this easier. One, there is clearly an awful lot of data. We're not short about data to make decisions or to understand that actually we can make better returns out of this. That data also helps to point us to the fact that many of these decisions drive you to lower risk investments and of course to better returns. One thing I was going to flag on the way through, and this is more from an institutional investor perspective, and that is the payback period. If you are an airport and you invest in solar energy and that takes your power costs down, then the next time you revalue your asset, which will be the next quarter after you finish the project, all those those benefits flow through and can be capitalized straight away. So the payback periods for some asset owners can be incredibly short, and that's a real motivator to act. That's probably a neat segue to impact, and we've talked today about the impact on buildings. There are places where implementing these things can have a very quick return, even if not in financial terms, then in terms of impact on employees and other stakeholders that are involved. We've also had some great examples of where these sorts of investments can drive resilience in the properties you're investing in and can make them more flexible. This is all a good example of there's nothing not to like about all of this. A quick word to ask for your support. If you have enjoyed this, then please do share links to this with your friends. Please do post on social media. If you're watching on YouTube, or even if you're not, go and hit the subscribe button or the like button. This helps spread our guests' messages much wider. Now, just looking ahead very quickly at what's coming up over the next couple of weeks. Next week, the same time, of course, 5 o'clock East Coast, 2 o'clock on the West Coast, and corresponding times across Europe, Africa, and Asia Pacific. We have the Impact Investing Handbook, and looking at how the importance of collaboration in impact investing with a great group. I participated in the discussion for that today. It's going to be extremely interesting and I think very practical. The week after that is the 100th anniversary of the ratification of the 19th Amendment to the US Constitution, women's right to vote. And this is going to be, I can promise you, a thoroughly lively session where we're looking at really where do we go from here? How far have we come? Why is urgent action needed? What should the goals be? And how can we act now to continue to drive real progress? And how do we measure results? And then at the end of the month, it seems crazy that it would already be the end of August by then, but it will be, the monthly Green Jobs Report and how green jobs are weathering the recession. This is a regular monthly session. So for more information on any of these shows and for links to recordings of previous shows, please visit esgx.org. And Paul, if there's anything else you'd like to add at the end, I'll hand it over to you. Otherwise, I'll wish everybody a very good evening.
We are ready to go. My wife is home. My puppy is happy, and wish everybody safety and health this week. And we'll see you next time on the next ESGX.